What's up, builders? This is Raise the Bar Radio, where we talk about building wealth, raising capital, and all in all, raising the bar in your business and your life. This is the No BS podcast for capital raisers, investors, and entrepreneurs who are serious about scaling their business and living life on their own terms. I'm Seth Bradley, securities attorney, real estate investor, and entrepreneur, bringing you world-class strategies from the best in the game. If you're ready to raise more capital, close bigger deals, build a better you, and create true financial freedom, you're in the right place. Let's go. Reg D, 506B versus 506C. Which one makes you more money? You're about to raise capital for your next real estate deal, and someone tells you, just file under Reg D, 506B or 506C. But hold up, is that actually the best way to maximize your raise, or are you leaving money on the table? Today, I'm breaking down the real difference between 506B and 506C, and more importantly, which one will put the most money in your pocket as a capital raiser, while I'm keeping you, of course, out of trouble with the SEC. Real quick, if you don't know me, I'm Seth Bradley, securities attorney, real estate investor, capital raiser. I'm here to show you how to scale your business while staying compliant and out of the SEC's purview. Let's get it. All right, first, the basics of Reg D, what you need to know. All right, let's keep this simple. Both 506B and 506C fall under what's called Regulation D, which is an SEC exemption that allows you to raise money for private investors without registering it as a public security. This is why syndicators, fund managers, capital raisers, we all love it. It's faster, it's cheaper, and doesn't require SEC approval before you start raising capital. But here's where most people get confused. These two exemptions are not the same, and picking the wrong one can limit your ability to raise capital or even get you into legal trouble. So let's figure this thing out together. Next, let's go through 506B first. It's the old school relationship-based method. So 506B, it's the old school country club method of raising capital. It allows you to bring in up to 35 non-accredited investors. That's significant, but here's the catch. You cannot advertise, you cannot solicit. So that means no Facebook ads, Instagram posts, no blasting your deal to strangers, no talking at a networking event about your deal. The SEC says you must have a pre-existing substantive relationship with your investors before they invest. So what does that mean? Well, if you just met a person at a networking event last week and now you're pitching him your deal, you could already be violating securities laws. The SEC has cracked down on this, and if they think you're using 506B as an excuse to backdoor advertise, they will come knocking. That said, 506B has its place. If you have a strong investor network, you don't need to publicly advertise. This exemption gives you more flexibility with investor qualifications because you can bring in non-accredited investors, not just accredited investors. Pardon the interruption, but we don't do ads. Instead, know that if you're raising capital for real estate, my law firm, Raise Law, is here to give you the expert legal guidance you need to raise capital compliantly and structure and close your deal. And if you're looking for a done-for-you fund-to-fund solution, TribeVest is the industry's only all-in-one setup and fund administration solution. Visit raise.law and tribevest.com to learn more. 506C, the modern, kind of a more scalable approach. The exemption that lets you go big. With 506C, you can advertise freely, you can talk freely, you can post your deals on social media, you can run paid ads, you can do webinars, you can shout it from the rooftops if you want. You're no longer limited to people that you already know. You can talk to strangers about it. But here's the trade-off. As noted before, every investor must be accredited, no exceptions. That means each investor needs to prove that they have either $1 million in net worth, excluding their primary home, or an income of $200K per year, if you're married, $300K combined. And you, as the syndicator, must verify this. Self-certification is not enough. Typically, you'll have investors submit CPA letters or a letter from their attorney, brokerage statements, or a third-party verification company such as Parallel Markets. This means fewer investors can participate, but the ones that can have deeper pockets, and if you structure your deal right, you can raise money way faster, scale way bigger, and you're gonna have less headaches because these people are gonna have more money. So they're not giving you their last $50,000. All right, so we've talked about high level, 506B, 506C, but which one makes you more money? That's the question. Which one actually makes you more money? So, well, it depends on your business model. If you already have a strong investor network and you don't need to solicit, you don't need to advertise, 506B might be the best bet because you can take both accredited and non-accredited, or what we call sophisticated investors. This is great if you have repeat investors who trust you, or you already have that built-in network that you already know. But if you want to scale, attract institutional money, and market openly, then 506C is the clear winner, and it's really the only option. You get bigger checks, fewer investor headaches, and the ability to automate and market your fund. The biggest syndicators I know, they're all using 506C because they want the ability to raise capital at scale. The old school guys who like keeping it private, they stick with 506B. You have to decide what fits best for your model. Okay, let's structure your deal the right way. Bottom line, choosing the wrong exemption could cost you millions. If you mess this up, you can get stuck with fewer investors, slower raises, or if you don't follow the rules, even SEC violations. We definitely don't want that. So, at Raise Law, we structure bulletproof syndications that protect your business, maximize your ability to raise capital, and keep you legally compliant. So before you launch your next fund, let's make sure you're using the right exemption for your goals. Hit the link below, schedule a call, and let's build your deal the right way. All right, folks. Thanks for tuning in to Raise the Bar Radio. If you enjoyed today's episode, make sure to subscribe, leave a review, and share it with someone who needs to hear it. Keep pushing, keep building, and keep raising the bar. Until next time, enjoy the journey.